Hello and welcome to another deep value video. Today we're taking an in-depth look at Constellation Brands, ticker symbol STZ. We'll dive into the financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Constellation Brands Incorporated is an American producer and marketer of beer, wine, and spirits. As of the 4th of October, the stock is priced at $243 with a market cap of 46.5 billion. Now, let's dive into some key valuation metrics. The price to earnings ratio stands at 20.1 and the price to cash flow ratio is 16.6. Over the past 5 years, the company's revenue has grown by 19.3% and its bottom line has increased by 14.3 thousand percent. In terms of earnings per share, there has been a growth of 15.5 thousand percent. Notably, the number of common shares outstanding is 183 million with a minus 4.4% change over the period. Now, let's assess the company's liquidity and solvency. The interest coverage ratio is 8.25, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity position, is 0.53. This suggests a high inventory and low ability to handle short-term shocks. Additionally, the long-term debt equity ratio is 1.35 and the total debt equity ratio is 1.47, both suggesting a high debt load. Although not that high compared to other companies, it is pretty high, and they should probably reduce their debt. Shifting to the cash flow statement, cash from operations stands at 2.78 billion, reflecting a growth of 9%. Cash from investing activities is minus 1.3 billion, with a plus 141.9% change, while financing activities are at minus 1.47 billion, showing a minus 27.3% change over the same period. Capex has increased by 74.8%, and his free cash flow has decreased by 33.8% to 1.14 billion. Moving forward, let's look at the return metrics to see how the company is utilizing these resources. The return on equity is 24.5%, which gives us an idea of the profitability relative to shareholders' equity. The return on investment is 16.2%, and the return on assets is 9.7%, both indicating how efficiently the company is generating returns from its investment and assets. And additionally, the return on invested capital stands at 12.4%, a crucial metric for understanding the effectiveness of the company's capital allocation. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis by using a discount rate of 10%, a revenue growth rate of 5% for 10 years, and a perpetuity growth rate of 2%. We get a fair value of $149.1. Secondly, using a multiple variation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $313. Thirdly, the average price target is $297. Putting it all together, we get an intrinsic value of $253, and using a 15% margin of safety, we get an acceptable buy price of $215.28, suggesting that our stock at the current levels is fairly valued. To wrap up my analysis, I will rate Constellation Brands as a whole, and I would personally only invest in the stock if its price drops to sub 100 levels, as I believe that their growth prospects are pretty bad, as you can see from their net income, which fluctuates by a lot. Some years they lose, some years they gain a lot of money. There was also really not that much to gain from their dividend, which is a pitiful 1.5% yield. Yeah, I don't really think this is much of a value play. This is not a growth play, so this would actually only fall into one category, a value play if its price dropped. As I've said, there's really not much to gain from this company. It's not a great long-term compounder. It's not it's not a company which has much growth potential. Of course, there's also the problem with their short-term liquidity and their debt. I believe that their debt is a bit high, but if they manage to slowly reduce their debt over the next, I don't know, 10 years and manage to stabilize their net income to make it more predictable, reduce their capex to a manageable amount without destroying their free cash flow. Because at the moment their capex has increased by a lot and the free cash flow has decreased because of that. They need to get the capex in line. But I think that the current situation doesn't really present a good investment, so I would advise you to do your own due diligence if you want to invest in Constellation brands. But as I've said, I consider investing it only if it's priced up to sub 200 levels. Thank you for watching. If you found this video helpful, please like and subscribe for more deep value analysis. See you in the next video. Bye.